What you were about to watch was scripted and produced in 2025. I did not publish it then. I held it back because I wanted to wait until the data caught up with the warning. It is now April 2026, and it has. Everything you were about to hear, the assets, the patterns, the cycle, treat it as the setup. At the end of this video, I will show you exactly how it played out in real time. Let's start from the beginning. October 1973. Two Americans in two different cities made the exact same observation on the exact same day. Richard Caldwell, 47 years old, middle manager at a General Motors assembly plant in Detroit, sat in his kitchen reading the morning paper. The headline said Arab nations had just announced an oil embargo against the United States. Richard had $28,000 saved. $18,000 in GM stock through the Employee Purchase Program, $6,000 in a growth mutual fund, $4,000 in his savings account at Detroit National Bank. He read the headline. He turned the page. 800 miles southwest in Houston, Margaret Santos, 44 years old, an independent accountant, read the same news in the Wall Street Journal. She had $23,000 saved, $5,000 less than Richard. She read the same headline. She did not turn the page. What Richard did next cost him half his wealth in 14 months. What Margaret did next made her one of the few Americans who came through the 1973 oil crisis with more money than she started with. And here is why I'm telling you this story, right now in 2025. The International Energy Agency released a report this week. The exact words, "The current disruption risks exceed both 1973 and 1979 combined." In 1973, the Arab oil embargo removed 4.5 million barrels per day from global supply. That was enough to crash the stock market 48%, spike inflation to 12%, and trigger a recession that lasted 16 months. The IEA says the current disruption threatens to remove 20 million barrels per day. That is not a typo, 4.4 times larger than 1973. My name is Ban, and I spend way too much time going through Federal Reserve archives, IEA reports, and commodity price histories tracking the patterns that repeat every single time an oil shock hits the global economy. I am not going to tell you what might happen. I am going to show you what has happened every single time this pattern has run since 1973. 4 times, 4 recessions, 4 stock crashes. 4 wealth transfers from people who did what Richard did to people who did what Margaret did. This video is the historical roadmap, what worked, what failed, what the actual numbers show. If you find this valuable, consider subscribing. I publish 3 videos every week breaking down financial patterns most channels ignore. Here is the thing about oil shocks that almost every expert gets wrong. They treat them as temporary supply disruptions. The price spikes, then it normalizes, then everything goes back to the way it was. That is not what the historical record shows. Not once. Not in 1973, not in 1979, not in 1990. The historical record shows something much more systematic. It shows a 4-phase wealth transfer that moves money from one group of people to another group of people over 18 to 36 months. I call it the oil shock wealth transfer cycle. There are 4 phases. Phase 1 is denial. This lasts roughly 6 weeks. The shock happens, markets dip, experts appear on television saying this is temporary, this is overreaction, this will normalize. Most investors do nothing. They hold their positions, they assume the system will correct itself. This is the window when smart money exits. Richard Caldwell was in Phase 1 denial. He read the headline, he turned the page. Phase 2 is price transmission. This starts around month 2 and runs through month 6. Oil prices spike, then gasoline prices spike, then diesel prices spike. Then everything that moves by truck or ship or train becomes more expensive. Grocery prices rise, shipping costs rise, airline tickets rise. Inflation readings start climbing. Bond yields rise because lenders demand compensation for inflation. Stock prices begin a sustained decline. This is not a dip anymore. This is the beginning of a bear market. Phase 3 is demand destruction, month 6 through month 18. High prices have crushed consumer spending. People stop buying things they do not absolutely need. Recession begins. Unemployment rises. Corporate earnings collapse because their costs are higher and their customers are spending less. The stock market finds its bottom somewhere in phase 3. Energy sector stocks outperform everything else because they are the only companies whose revenues are rising.
Phase 4 is reallocation, month 12 through month 36. The people who held cash and energy positions during phases 2 and 3 now deploy that capital. They buy crashed assets at 40 to 60% discounts. Wealth transfers from those who held growth stocks and hoped for recovery to those who repositioned before the cycle began. Now, let me show you where Richard and Margaret entered this cycle. Richard entered phase 1 in denial. He held his GM stock, his growth fund, his savings account. He did nothing. He rode the cycle all the way through. Margaret recognized phase 1. Within 30 days of the October 17th embargo announcement, she repositioned. She sold $8,000 in equity positions. She bought 400 ounces of silver at $2.90 an ounce. She bought $6,000 of Exxon stock. She moved $5,000 into 6-month Treasury bills yielding 7.8%. She kept the rest in cash. Let me run the numbers on what happened next. October 6, 1973. The Yom Kippur War begins. Egypt and Syria launch a coordinated attack on Israel. Oil is not yet weaponized, but the clock is ticking. October 17, 1973. OAPEC, the Organization of Arab Petroleum Exporting Countries, announces an embargo against the United States. They announce production cuts of 5% per month until Israel withdraws from occupied territories. October 19, 1973. President Nixon requests $2.2 billion in emergency military aid to Israel. Saudi Arabia responds by announcing a total embargo on all oil shipments to the United States. November 5, 1973. Arab producers announce a 25% production cut from September levels. Oil prices have already risen from $3.01 per barrel to $5.11, a 70% jump in 3 weeks. January 1, 1974. OPEC sets the official oil price at $11.65 per barrel. This is a 287% increase from the pre-crisis price of $3.01 in 4 months. Now here is where the pattern gets strange. The stock market does not crash immediately. It drifts lower through late 1973. Investors are in denial. They think this is temporary. They think the embargo will end and prices will normalize. The embargo does not end. December 6, 1974. The S&P 500 hits its bear market low, 62.28, down 48.2% from the January 1973 peak of 120.24. Let me say that again. The broad U.S. stock market lost nearly half its value, 48.2%, in 23 months. Now let me show you what happened to Richard and Margaret during those 23 months. Richard's GM stock. General Motors was one of the worst-hit companies in America. Their cars were gas guzzlers. Demand collapsed. The stock fell 58%. Richard's $18,000 became $7,560. Richard's Growth Mutual Fund. The investor's stock fund was a typical growth fund of the era. It fell 43%. Richard's $6,000 became $3,420. Richard's savings account. $4,000 sitting in Detroit National Bank, nominally safe, but inflation hit 12.3% in 1974. The purchasing power of that $4,000 fell to approximately $3,120 in real terms. Richard's total. $28,000 became $14,100 in real purchasing power, a 49.6% wealth destruction. He lost half of everything he had saved by doing exactly what most Americans did, nothing. Now Margaret's silver, 400 ounces at $2.90 per ounce,
Total investment, $1,160. By December 1974, silver had risen to $4.39 per ounce. Her 400 ounces were worth $1,756, a 51% gain while the stock market crashed. Margaret's Exxon stock. She bought $6,000 of Standard Oil of New Jersey, which we now call Exxon. While the S&P 500 fell 48%, Exxon rose 22%. Her $6,000 became $7,320. Margaret's Treasury bills. $5,000 in 6-month T-bills yielding 7.8%. She rolled them twice. Interest income of approximately $390, principal intact. Margaret's cash, $2,840, still $2,840. Yes, inflation eroded some purchasing power, but she still had liquidity when Phase 4 arrived. Margaret's total, $23,000, became approximately $27,300 nominally. Adjusted for inflation, she still lost some real value, approximately 7.4%. But Richard lost 49.6%. Margaret lost less than 1/7 what Richard lost, starting with $5,000 less. But it gets darker. This was not the last oil shock, and the pattern repeated with disturbing precision. The second oil shock, 1979 to 1980. The Iranian Revolution removed 4.8 million barrels per day from global supply, almost identical to the 1973 shock in volume. Oil prices rose from $15.85 per barrel in 1979 to $39.50 in 1980, a 149% increase. The S&P 500 fell 27% between 1980 and 1982. Inflation peaked at 13.5%. The Federal Reserve raised interest rates to 20% in June 1981 to break the inflation. This triggered the severe recession of 1981 to 1982. Gold, $226 per ounce in January 1979. $850 per ounce in January 1980, a 276% gain in 12 months. Energy stocks outperformed the broad market by 45% over the 3-year period. Same pattern, same phases, same wealth transfer. The third shock, 1990. Iraq invaded Kuwait on August 2, 1990. 4.3 million barrels per day removed from global supply. Oil prices rose from $21 per barrel in July to $46 in October, a 119% spike in 3 months. The S&P 500 fell 20%. Recession began in July 1990 and lasted until March 1991. This shock was shorter. The Gulf War resolved quickly. Prices normalized faster, but the pattern still held during the acute phase. Gold rose 8%. Energy stocks outperformed during the shock. And now here is why I am spending so much time on these historical cases. The IEA just told us this week that we may be looking at a shock 4 times larger than any of these. Let me put the numbers side by side. In 1973, the embargo removed 4.5 million barrels per day. That was 7.5% of global supply. It caused a 48% stock crash, 12% inflation, and a 16-month recession. The IEA's current assessment says geopolitical disruption risks removing 18 to 22 million barrels per day. Global production is approximately 102 million barrels per day. 20 million barrels is roughly 20% of global supply. That is not 7.5%, that is 20%, almost 3 times the proportional impact. But it is actually worse than that. In 1973, the U.S. Strategic Petroleum Reserve was full, 293 million barrels. Today, it is at 347 million barrels. That sounds like more, but demand has increased, and we have been drawing it down for years. It is at its lowest level since 1983.
In 1973, OPEC had roughly 5 million barrels per day of spare production capacity. They could ramp up if they chose to. Today, OPEC's spare capacity is approximately 2 million barrels per day. There is no swing producer that can flood the market to bring prices down. In 1973, U.S. debt to GDP was 35%. Today, it is 122%. The government has far less room to stimulate the economy during a recession. In 1973, the Federal Reserve had room to maneuver. Today, the Fed is already at elevated rates with inflation still above target. The starting conditions in 2025 are worse than the starting conditions in 1973 on almost every measurable dimension, and the shock is 4 times larger. Now, here is why this matters to you specifically.
If you have a 401k, an IRA, a brokerage account with broad market index funds, you are Richard Caldwell. You are sitting in the same position he sat in during October 1973. The news has broken. The IEA report is public, and most people are doing exactly what Richard did. They are reading the headline, they are turning the page. The wealth transfer cycle has a phase 1. That phase is denial. That phase lasts about 6 weeks historically. That phase is when repositioning is still possible without selling into a crash. Look, the first thing we need to talk about is protecting what you already have. The historical record shows that 3 asset classes have protected purchasing power during every oil shock since 1973. Energy stocks, precious metals, and short-duration government securities. Energy stocks first. During the 1973 shock, Exxon rose 22%, while the market fell 48%. Chevron rose 19%. Texaco rose 31%. During the 2022 energy crisis, the Energy Select Sector SPDR, ticker XLE, returned 64%, while the S&P 500 fell 18%. The pattern is not subtle. When oil prices spike, oil companies make more money. Their stock prices rise while everything else falls. The modern equivalent is XLE. It holds Exxon, Chevron, ConocoPhillips, Schlumberger, and the other major energy companies. If oil goes to $150 a barrel, these companies will be printing cash. Gold second. During the 1973 shock, gold rose 200%. During the 1979 shock, gold rose 276%. Gold is both an inflation hedge and a crisis hedge. It does both jobs at once during an oil shock. The simplest access is SPDR gold shares, ticker GLD, or physical coins held outside the banking system. The historical record suggests 10 to 15% of portfolio is the range that provided protection without overconcentration. Now, here is where it gets interesting. While everyone is panicking about oil prices, there's an asset most people forget about: Treasury inflation-protected securities, TIPS. The principal value of a TIPS bond adjusts with the Consumer Price Index. If inflation spikes to 10%, your principal increases by 10%. You are not losing purchasing power the way you would in a regular bond or a savings account. During the 1970s, TIPS did not exist. Investors had no direct inflation hedge in the bond market. They do now. The iShares TIPS Bond ETF, ticker TIP, provides direct exposure. This is what a 2025 version of Margaret Santos would own. And cash, not in a checking account that earns nothing, short-duration treasuries. The SPDR Bloomberg 1 to 3 month T-bill ETF, ticker BIL, gives you liquidity, safety, and a yield. This is your Phase 4 ammunition. When stocks bottom, and they bottomed at 48% down in 1974, 27% down in 1982, 20% down in 1990, you need capital available to deploy. Richard did not have capital available. He was fully invested in falling assets. Margaret had cash. She had liquidity. When Phase 4 arrived, she could act. But here's the thing. You need to be watching for these signals. Signal 1. WTI crude oil crossing $120 per barrel and staying there for 2 or more weeks. This is Phase 2 confirmation. Price transmission has begun. The inflation spike is coming.
Fred tracks this daily under series DCO-ILWTICO. You can set an alert. Signal 2. Consumer Price Index month-over-month readings above 0.6% for 3 consecutive months. This means inflation is not transitory, it is transmitting through the economy. The Bureau of Labor Statistics releases this monthly. This signal preceded every recession in the 1970s oil shock sequence. Signal 3, the VIX, the Fear Index, above 35 for 5 or more consecutive trading days. This typically occurs 2 to 4 weeks before a stock market bottom. It is the capitulation signal. When you see it, Phase 3 is ending and Phase 4 is approaching. Most people will not watch these signals. Most people will do what Richard Caldwell did. They will assume this is temporary. They will hold their positions, they will watch the headline and turn the page. Richard Caldwell held GM stock through the entire cycle. By December 1974, when the market bottomed, he had lost half his wealth. He had no cash to deploy. He had no energy positions that had risen. He had no precious metals that had preserved value. He had nothing but a depleted portfolio and a lesson learned too late. Margaret Santos exited her equity positions in Phase 1. She bought silver. She bought Exxon. She bought treasury bills. She kept cash. 14 months later, while Richard was watching his net worth collapse, Margaret was calculating her next move. She had capital. She had options. She had the ability to buy crashed assets at 50 cents on the dollar. That's the oil shock wealth transfer cycle. It has run 4 times since 1973. Every time it transferred wealth from people in denial to people who repositioned early. Every time the same asset classes won, every time the same asset classes lost. The IEA just told us this week that we may be entering a shock 4 times larger than any previous one. The question is not whether the pattern will repeat. The pattern has repeated every time, with only minor variations in timing and magnitude. The question is whether you are Richard Caldwell or Margaret Santos. The headline is in front of you right now. You can turn the page, or you can do what Margaret did. The date is different. The pattern is identical.
Everything I just showed you, the cycle, the 4 phases, the asset classes that protect and the ones that destroy, that was built on a century of historical data and an IEA warning that most people read and turned the page on. History just repeated itself, in real time, while this video sat in my edit folder. It is now April 2026, and I need to show you what happened. On February 28, 2026, the United States and Israel launched coordinated airstrikes on Iran. Within days, shipping through the Strait of Hormuz, the choke point that carried roughly 20 million barrels of oil per day, collapsed to near zero. The IEA made it official. Executive Director Fatih Birol's exact words, "The war in the Middle East is creating the largest supply disruption in the history of the global oil market. Not 1973, not 1979, not 1990. The largest ever." Gulf producers slashed combined output by at least 10 million barrels per day. The IEA responded with its largest ever emergency reserve release, 400 million barrels unlocked from strategic reserves. Analysts called it a garden hose on a refinery fire. Brent crude surged over 55% in March alone, the biggest single-month gain since the contract began trading in 1988. It peaked near $120 per barrel. The S&P 500 has declined approximately 7% since late February. 8 of 11 sectors are down. The only sector up in both price and analyst targets is energy. The S&P 500 Energy Index is up 29% year-to-date, on track for its best annual performance since 2022. Exxon, Chevron, ConocoPhillips, exactly the names the historical pattern pointed to. Moody's recession probability model now sits at 49%. Every time that model has crossed 50% in 80 years of data, a recession followed within 12 months. We are deep inside Phase 2 of the cycle I described. Price transmission is running. The denial phase is over. I do not need new research to tell you what comes next. I already showed you the framework. Phase 3 is where most people are right now. Demand destruction is beginning. Corporate costs are rising. Consumer spending is slowing. The market has not found its bottom yet. Energy stocks continue to outperform everything else because they are the only companies whose revenues are rising while everything around them falls. Phase 4 follows. It always follows. The people who held cash and energy positions through Phase 2 and Phase 3 will deploy that capital into crashed assets at 40 to 60 cents on the dollar. The wealth transfer runs exactly as it has run 4 times before. The only variable is timing, not outcome. When I made this video, I told you the IEA had issued a warning. I told you the pattern was setting up. I told you the same cycle that ran in 1973, 1979, 1990, and 2008 was preparing to run again. It is running right now. The asset classes that protected Margaret Santos are outperforming exactly as the historical record predicted. The asset classes that destroyed Richard Caldwell are declining exactly as predicted. I held this video back because I wanted to show you something most financial channels will never do. I wanted to show you the warning and then show you the verification, not a forecast, a confirmation. The question I asked you at the start of this video still stands. Are you Richard Caldwell or Margaret Santos? The headline is not in front of you anymore. The headline is behind you. The cycle is already running. The window that Margaret used to reposition, that Phase 1 window, has closed. But Phase 3 has not ended, and Phase 4 has not yet begun. The date is different. The pattern is identical. This is Ban. Stay sharp out there.